Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is going to be your daily cryptocurrency market update, and we have got quite a lot of interesting things to get into. We're really going to be recapping on what took place yesterday with the non-farm payroll data. This is essentially US economical data that shows you essentially what's going on in terms of unemployment and the labor force. Now, why the hell, as crypto traders, should we care about this? Well, it's a good exercise to ask that question with you guys, because essentially this data moved markets, and it moved them in the exact way that we said it was going to. A good report showing that you're still actually adding jobs and unemployment continues to fall is going to show the Fed that they have the support of the labor market to continue to do what they're doing. And we've gone into great lengths in regards to what it is they're doing and how detrimental it is for markets, certainly high beta markets like the crypto space, but also the stock market. Because what you're essentially seeing with the Fed's crusade to kill off inflation is how they're doing that is by demand destruction. They're doing that via draining liquidity. And how that kind of works in a monetary fashion is essentially that money now needs to go back to pay the debt that has a higher interest bearing on it. So this is why we care about this. You know, we know the correlation between Bitcoin and the dollar. They did all that printing. We saw the dollar absolutely tank. And now they are, starting to look at fighting inflation again. Or looking to kill inflation via upping interest rates. It's why we're seeing lots of emerging nations like the euro end up in trouble, and the pound is because the dollar is eating everybody's lunch. So this is extremely important data. It was very positive. We are going to speak about the labor market again, because even though unemployment is falling for now, meaning that the labor market is strong, there is a turning point coming, in my opinion, as we slip into more of a deeper recession. And we start to see those layoffs, we start to see those defaults, so on and so forth. I think the yield curve, the 10s and 2s for the US, essentially is predicting a debt failure in many regards. And we saw that start to happen in the UK with the gilts. Germany's looking like a similar thing's going to take place there. And the interesting thing with the gilts is even though the government has stepped in and spent or pledged to spend double the defence budget in the UK, 67 trillion, billion, not trillion, my apologies. We're still seeing that market continue to roll. And the bond market, the treasury market, is literally fundamental to our financial systems. If that falls, you're going to see pensions default, blah, 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 blah. This is not a drill. We've said all this in great detail. It's why we're out of markets. None of this has to happen. But if it does, you're going to be happy that you're sat on the sidelines. We're not totally sidelined. We still have a little bit of exposure to crypto, but we've been dollar, even though I live in the UK, dominant really since 44K for Bitcoin, and we're currently trading sub 20. All those bottom callers over here look rather stupid now, but guess what, guys? We've all made wrong calls. Very hard to call the market perfectly. So this did exactly what we thought it did. The scary thing for me is just how badly the stock market is reacting to all this. I mean, the Nasdaq closed 3.8% down, the S&P 2.8%. UK FTSE didn't really do a lot. The dollar is showing insane amounts of strength, and there's lots of talk about this kind of double top for the dollar around about 120. That could be the spike that it has that sees all markets sort of roll over, but it's really going to depend. I think we've got the CPI coming out next week, and then, of course, we're going to get a lot more from the Federal Reserve as well. We've already had quite a lot this week in terms of speakers, and they have all said, look, we are expecting issues in the housing market and markets, and we're kind of expecting and predicting pain because we understand what we're doing. We've seen the results of it so far. The thing is, the Fed don't give a damn. Every time the market rallies, it's almost like a slap in the face to what they're doing. If they gave a damn about the markets, guys, they would have, this is just showing you how money works with the liability and the asset being the money. If they gave a damn about markets, they would never have allowed it to fall this badly. So we'll wrap up quickly on the non-farm payroll. This was a decent number. It shows that the labor market is tight. It essentially also shows that unemployment is falling. So I think unemployment is now down to 3.5, I think. Yeah, 3.5. It was at 3.7. We are on this turning point where you start to see unemployment skyrocket and go up as we enter and this recession gets deeper. This is where I think we are. We're at this kind of key turning point. And there is data that does support this. This is the most important chart of the day. Non-farm payrolls within 3 to 4 months of capitulation. Market pricing of a Fed pivot early next year makes sense. And you can see this is leading by 5 months. The US non-farm payroll month on month. And the NFIB hiring plan momentum RSI is looking like, this is essentially predicting that you are going to get what we said is a real fear of ours, this sort of spike in unemployment. That it's a double-edged sword, that, because that actually isn't really good for markets, even though it's going to, and we know what's driving. Also, talking about this non-farm payroll data, what did we see in the euro dollars? Let's put it on a daily. We got this candle here. This was on the non-farm payroll. Again, this is pricing went down, pricing in interest rates going up. What else did we have? Let's look at the 30-day futures. That also had a bit of a negative day, as well as people are going to be pricing in also dollar up, more hikes for longer. And that's still the kind of mandate that we're on. Again, that's going to continue is already draining liquidity from markets massively, but is going to continue to do so. You also have inflation on the other side of that, which is literally killing the consumer off and taking money out of their pockets because they've got to spend it on their, normal bills that have gone up 100% now. Everyone's broke. This is why we don't get into markets in this kind of an environment. Until we see that money printer turn on, and we'll keep you guys up to date with it on this channel, we stay very much out and vigilant. And in this kind of a situation, there's serious risk other than the kind of flow of money. There's for goodness sake, Biden coming out and talking about an Armageddon. Not that I think that's necessarily on the cards, but it's very unprecedented times that we live in. I think that this is my take, just as a little side note. I think that governments, certainly the US, are now looking for somebody that they can sort of pin up as the blame for this crash. So I think they're looking for that Lehman's, and I think when they get it, they'll allow things to really roll. And then they can come out and say, it was Russia that did this, or it was, whoever it is, and sort of pass that blame off. And really, this is the fallout from March 2020. You don't print this sort of money and then don't have a hangover after it, after everybody's enjoyed spending it and buying a new car and this, that, and the other. And we're now in the fallout of that. So money is no longer free. Barclays did a report on that that I got sent. Forcing liquidations abroad. Wall Street barometer has broken multiple technical levels. Bank of America says margin calls will show up once the SPX breaks 3,600. So 3,600, forcing liquidations. So the thing is, you're now actually, and this is why we've said you can't use it's why we've disproven lots of the on-chain guys, because this is not whatever you had prior from on-chain data when Bitcoin was in a, just following the 4-year cycle theory, and Bitcoin in comparison with markets has just gone up. Markets have just gone up since 2008 with the money supply. We've never had to enter this kind of a situation. So anything historically that's happened has been happening on the backdrop of printing free money, QE. Whereas now we're in QT, and it's a serious QT, and we're seeing that show up in markets. This is the largest wealth destruction ever, really, since this year. People still don't get that, and they go, okay, well, it can't get much worse. Famous last words, ladies and gentlemen. It gets a lot worse, in my opinion. I honestly think that there's a lot of sort of behind-the-scenes string pulling to bring a lot of this on, in my opinion. I don't think... I always ask myself this question. Are central banks and governments that stupid? Maybe. Or maybe there's something else going on. Just food for thought. So, yeah, we are going to start to see, as things get lower, just like with the bond market capitulating. The reason I had to step in there is because if it continues to lose value, pensions would go insolvent. Imagine how many funds are out there that hold S&P, NASDAQ, bonds that are all getting smashed. This was from Lynn Alden. Pretty sure Powell will tighten until he breaks the Treasury market. This was a tweet from hers. Lynn Alden's a great person to follow, by the way, guys. The Fed is going to tighten monetary policy until something breaks, something like Treasury market liquidity or credit market, while ISM PMI is declining. Being defensive makes sense until pivot occurs. Diverse-based mix of cash, gold, defensive value, equities, etc. So I wouldn't even touch equities or gold. I think everything's going to get smashed. I think you're actually, believe it or not, and this is insane for me to say this as a channel that's called All in Crypto, and technically we are in stable coin, so that is a crypto. We are all dollars. We think a dollar milkshake kind of event is going to take place, and we think everything is going to get smashed, and it's no coincidence. We're holding dollars right now. Little bit of crypto exposure, little bit of gold and silver exposure. The real, and we'll do a separate video on gold and silver if anybody wants that video, because there is an argument for gold and silver, but it really relies on, I'm bullish on anything essentially that is against the fiat systems, which inherently have to be inflationary to maintain the system that will never be able to pay itself off. So this is an interesting tweet from Linolden. Totally with her on this. This was a while ago, actually, in April. If you guys go on my Twitter, you'll see that we were talking about this sort of stuff back in April as well. We were talking about, you know, a real interesting situation that's setting up. September job gains affirm that the Fed has a long way to go in fighting inflation. So why would the Fed pivot when inflation is at this kind of level? And the CPI is going to be crucial, you know, next week. But until they see some sort of a drastic reduction, you'd see markets, if inflation came out at 4%, right? Markets would do really well on the back end of that because it's a significant drop. We actually had slightly lower CPI last month than the prior, but it's still at 8+%. That's unacceptable by all accounts. And that's what they're telling you. Real inflation, you're probably talking, you know, 20, 50% in some areas. September's non-farm payroll report provided both assurance that the job market is strong and that the Fed will have to do more to slow it down. So this is the thing, again, we spoke about the fact if markets are rallying, it's a slap in the face to the Fed because they're trying to actively kill off demand. And we've said that's the key phrase that he keeps using. We're trying to bring supply in line with demand, or demand in line with supply. So we're going to kill off demand in order to bring it down to where the supply is and sort of, you know, thus kill off inflation by doing so. But they do that through wealth destruction. This is something that we're going to continue to highlight. You're going to see, and we spoke about this with the Market Sniper. You know, we're not there yet, but we're at the sort of critical turning point, in my opinion, where this starts to skyrocket. And you can see, you know, in the sort of grayer lines, you've done this at similar points in a recession. This one is going to be no different, and we're just waiting for that. This is a good indicator of that. This I thought was interesting. The Fed finally did it. They broke the market. The Dow Jones, 30 largest industrial stocks on planet Earth, is officially more volatile than Bitcoin. Something doesn't feel right. You know, we've still got all these draws. We still think you're in a head and shoulders. It's going to play out to around about 13,800. Something doesn't feel right here with why Bitcoin isn't moving as fast as the stock market to the downside. And the only reason I can put up for it is how many people have basically got a vested interest in keeping it here. When this rolls, just like with a SPY, you're going to see forced liquidations. You're going to see forced liquidations within Bitcoin and within the crypto market. We've already seen it. We've already seen the likes of Celsius implode, all these other Luna, blah. You know, that's going to continue the lower this goes. And until we've flushed all that chaff out that has irresponsibly, you know, longed and been, we've seen professional VCs and investors turn out to be, you know, mere gamblers. That there's still those players involved in this space. Things need to come lower to wash all them out, in my opinion. And I don't think we're too far off that horizon. And then people like me and you are going to be stepping in with the vacuum and hoovering everything up. So kind of worrying me that Bitcoin isn't doing this. Watch out for Sunday. I've got a feeling that things could roll this Sunday. Doesn't have to happen, but look at these wicks that you're getting on the weekly. What have we got here? We've not got the demand index on there, but look at these wicks. Very different. You know, where are all the, what's the side of all these wicks? Let's get off this chart so we can show you another. Yeah, look at all these wicks, guys. Just doing a little bit of basic Japanese candlestick analysis. Interesting. Yeah, let's not do that. What do we want? Look at these wicks. All of these selling wicks. You can tell just by doing candlestick analysis where the sell pressure is. You know, if you look at these shadows, yeah, okay, there's a few buyers, but generally, you know, we're looking for this continuation to the downside, and we still think our head and shoulders pattern is very much in play. This is not bottoming structure. You know, we did say, okay, maybe there's a double bottom here, but you've got to see that, and you've got to see that strength come in. Maybe the CPI does that, I don't know. But our bias is that things get a lot worse because of the kind of overall outlook for the economy. That's going to spill into the crypto space, just like, and people think TA doesn't work. It absolutely does. We're proving it to you on this channel. Just like people say, okay, we don't need to bother with looking at non-farm payroll because what has it got to do with the crypto space? Yeah, it moved our market yesterday. And if you were watching and you knew what you were looking at, you'd have been, you know, well equipped to deal with whatever was thrown your way. That is all I've got for you in this video, guys. Rambling on now. I'm going to love and leave you on that note. If you have enjoyed this content, like is always appreciated. So as a comment, I look forward to seeing each and every one of you in the next YouTube video. Have a wonderful Saturday, guys. See you in the next one.